Good day. I am Yehuda Folberg, Marketing Communications Coordinator for the Trendlines Group. With me today are Steve Rhodes and Todd Dollinger, Chairman and Chief Executive Officers of the Trendlines Group, and Chaim Brosh, Trendlines Chief Financial Officer, who will present the financial results and business updates for the half-year earnings of 2020 and answer questions at the end. To submit a question, use the questions and answer function in the conference call, or alternatively, send them to 972-5568-55682 via WhatsApp. The phone number again is 972-5568-55682. The slides for the half-year 2020 earnings presentation, as well as the financial results for the first half of 2020, are available on the investor page of the Trendlines website. Please note that this presentation may contain comments that constitute forward-looking statements which involve risks and uncertainties. Examples of forward-looking statements include descriptions regarding the intent, belief, or current expectations of the company or its officers with respect to future results of business operations and financial condition, industry, environment, and future events and plans of the company. Such forward-looking statements are not guarantees of future results, performance, or achievements. Actual results, performance, or achievements of the company may differ from those expressed in the forward-looking statements as a result of various factors, such as known and unknown risks and uncertainties. The assumptions include those risk factors discussed in the Trendlines offer document dated 16 November 2015 and in the company's filing on SGXNet, which you are encouraged to review. By their nature, forward-looking statements involve risks and uncertainties because they relate to events and depend on circumstances that may or may not occur in the future. In light of these risks and uncertainties, actual events, results, and developments could differ materially from those expressed or implied by forward-looking statements. The statements represent the company's or its officers' views only as of the date they are made and should not be relied upon as representing the company's or its officers' view as of any subsequent date. The company does not assume any obligation to update any forward-looking statements. Finally, please note, all monetary values cited are in US dollars unless otherwise specified. I will now turn the presentation over to Steve Rhodes, Chairman and CEO of the Trendlines Group.
Thank you, Yehuda. In the last 13 years, we're very proud of the portfolio growth that we've seen. Our total portfolio value, including cumulative exit proceeds, has consistently increased and reached $122.9 million at the end of June. At the end of the first half of 2020, the fair value of the portfolio itself was $88.5 million, compared to $102.8 million at 31 December 2019. This decrease was primarily due to the exit of ApiFix from our portfolio. Assets related to the exit, securities, accounts receivable, and contingent receivables totaled $15 million and appear on our balance sheet at the end of June. In addition, we had the write-down of Stematics GI. The initial revenues of Stematics are lower than previous projections as a result of the product's staggered launch. We further note that introducing new products into the medical market currently, due to the COVID-19 crisis, is particularly challenging. Net of these two events, the rest of the portfolio value increased by $4.3 million. Note, please, also importantly, that the portfolio value of $88.5 million does not include the value of our 11 Singapore-based portfolio companies, which currently are consolidated subsidiaries and are not reported at fair value. Now let's turn to some of the main corporate developments during the first half of 2020. As already noted, in the midst of the COVID-19 crisis, our portfolio company ApiFix was acquired by Orthopediatrics, a US orthopedics company. Todd will expand on that acquisition later. Our newly formed agri-food fund in Singapore made its first 3 investments in Equinome, a late-stage seed breeding company, in Insecta, an early-stage Singapore-based company focused on the extraction of valuable biomaterials from insects, and Saturas, a late-stage precision irrigation company. In addition, Trendlines established 2 new medical companies in the first half of the year, Center Care in Israel and STEP in Singapore. We are pleased to note that in the first half of this year, despite the challenges of fundraising due to the pandemic, a record high 27 of our portfolio companies raised more than $27 million in follow-on funding. This is particularly remarkable given that in all of 2019, we had 22 companies raise capital, which at the time was also a record. Through our monthly updates and our newsletter, we regularly publish information about companies that have achieved meaningful milestones. This half year boasted a long list of remarkable achievements by our portfolio companies in addition to the ApiFix exit. OrthoSpin, another orthopedics company, completed a $5 million raise led by Johnson & Johnson Innovation. This is the second investment that Johnson & Johnson has made in the company, and we believe that it bodes well for the future of OrthoSpin. Argol Food Tech, our company raising grasshoppers and producing alternative protein-based products from them, raised $3 million and began sales of their biblical protein energy bar product. AgroScout, our AI-based crop protection company, raised $3 million and began sales in the United States, Israel, and Latin America. Our company Saturas raised $3 million for further commercialization of its precision irrigation management system and launched sales in the US, Europe, Israel, and China. Alga Health raised 2.5 million shekels for the further development of its microalgae technology. And our Curo received CE mark, announced its US distribution agreement, and made its first shipment of commercial products for sale to the United States. The company also recently completed a $2 million raise in July of this year. So far, this has been a great year for our portfolio companies. Not only have more than 27 companies now raised capital, but several companies have launched sales despite the challenges imposed by the pandemic. I'll now turn the presentation over to Todd Dollinger, co-chairman and co-CEO of the Trendlines Group.
Thanks, Steve. We prepared this table to explain the ApiFix acquisition terms by publicly traded OrthoPediatrics Corp. And its impact on Trendlines. At the close of the deal on April 1, ApiFix shareholders received 934,783 new common shares in OrthoPediatrics plus $2 million in cash. Trendlines consideration amounted to 187,257 shares and $150,000 US dollars. The current value, based on the closing of OrthoPediatrics stock last night on the NASDAQ, is $9.6 million for the shares and the cash. That's a substantial increase, with the stock having moved from the April 1st closing date of $39 to last night at US $50.25 per share. According to the terms of the deal, the shares are locked up until October of this year. Moving on the second, third, and fourth anniversaries of the deal, ApiFix shareholders will receive guaranteed payments as set out in the table. The fourth payment will include, in addition to the guaranteed amount, an earn-out payment based on ApiFix product sales. Based on Orthopedics' recent share price, Trendlines consideration in total is $15.2 million US dollars, not including any earnout. There could be a truly substantial payment to us from the earnout that remains to be seen. At the start of the COVID-19 crisis, it became apparent that this pandemic was going to have a profound effect on all. Accordingly, we immediately made plans, first and foremost, for the safety and health of our employees in Israel, Singapore, and China. With China offices, we were early spectators to what was occurring, and the virus soon moved on to Singapore and then to Israel. All three countries substantially impacted, and fortunately, to date, none of Trendlines employees or their families have suffered directly from the virus. After ensuring the safety of our employees, our next response was to review the budgets and plans of all of our portfolio companies with the objective in these uncertain times of reducing expenses and lengthening their financial runways. We are cautiously optimistic that the impact will not be significant for most of our companies. That said, there certainly are challenges. Travel restrictions, lockdowns, and postponement of elective medical procedures in most parts of the world have impacted our abilities to connect with investors on a face-to-face basis, for our medical companies to complete clinical trials, and for some agri-food companies to travel for field installations. As most of the world has done, we've adapted quickly to using digital and online platforms to ensure that plans remain as best they can on track. More than ever, we're committed to giving our portfolio companies all of the support that they need to succeed in uncertain times. I'm now going to turn the presentation over to our CFO, Chaim Brosh, for review of our first half 2020 financial results and the components of our valuation.
Thank you, Todd. Let's start with a snapshot of some of our key financial development and information. As mentioned, the decrease in the fair value of the portfolio was mainly due to the removal of ApiFix, valued at $13.7 million, from the portfolio following its sales of the assets and presented in other balance sheet items, and write-down of schematic GI during this period. Net of those two events, the portfolio value increased by $4.3 million. Total assets decreased by approximately 4% from $125.5 million as of the end of 2019 to $119.9 million as of the end of June this year. This was mainly due to a decrease in cash of $5.5 million, a decrease in the investment in the portfolio companies of $14.2 million, which was offset by the increase in account, other receivable, and marketable securities in the amount of $13 million. The increase in long-term deposit at the amount of $4 million is due to the purchase of structured bank investment. Account and other receivables and contingent consideration receivables of $4.8 million and $2.5 million, respectively, in the first half of the year, represent the present value of risk-adjusted earn-out from the ApiFix exit, as it was explained before. Due to the above, our total cash, short and long-term deposit, and receivables and marketable securities reached a record high of $27.8 million, compared to $19.4 million as of the end of last year. During the first half of the year, we record a net loss of $4.1 million compared to a loss of $2.2 million at the first half of 2019, which will be explained now. Our Trendlines total income for the first half of the year was $225,000 compared to $1.6 million in the first half of 2019. Total income primarily reflects a reduction in the fair value of Trendlines portfolio companies, mainly due to a net increase of $5.8 million in the fair value of various portfolio companies, which was offset by a net decrease of $4.8 million of the value of schematics GI, as it was explained before, a decrease of approximately $2.7 million in the fair value of various portfolio companies, and a write-off of 3 portfolio companies, approximately $1.9 million, as a result of lack of funding for those companies. The fair value of our portfolio is reviewed at least once a year by an external independent valuation firm. Income from services to portfolio companies comprised approximately of $1.8 million, mainly as a revenue recognition of services we provide to our Israeli portfolio companies during the first 2 years of incubation. Income from contracted R&D services remained relatively unchanged compared to the same period of last year. Financial income increased by $1.7 million, mainly as a result of the adjustment in the fair value of the consideration received in the form of marketable securities resulted from the ApiFix exit, as it was explained before by Todd. Operating, general, and administrative expenses increased by approximately $200,000. The change was mainly as a result of the increase in the operating activity of the entire group. Net R&D expenses decreased by approximately $200,000. The decrease was mainly due to the grant from the Enterprise Singapore received in the first half of this year that offset some of the R&D expenses incurred by the Singaporean companies during the financial period. Our chart, key value components in the Trendlines portfolio, is an aid to help evaluate changes in our portfolio value and the calculation of our total equity based on that portfolio value. The impact of the change in the fair value of the portfolio companies in the valuation of Trendlines portfolio can be seen graphically on the chart, which track changes in the portfolio and the balance sheet compared to the end of last year. The first bar of the chart shows that we begin 2020 with a portfolio value of $102.8 million. The second and third bar show that during the first half of the year, the portfolio value increased by $9.6 million. The increase was offset by a decrease of $23.8 million, mainly, as explained during all of today's presentation, mainly as a result of the moving the ApiFix investment into other components of the balance sheet. In total, there was a decrease from $102.8 million to $88.5 million during the first half of the year. The second half of the chart will present the other component that contribute to the net asset value of the company. The first bar showed the $27.8 million in cash, short and long-term investment and accounts and marketable securities as of the end of June. This includes, among other receivables, a long-term bank deposit of $4 million, an additional to the increase in the account and other receivable and marketable securities in the amount of $4.9 million and $7.7 million respectively. Those components represent the items that were removed from the portfolio value, as I explained before. Following are our three main non-cash long-term liabilities items, represented by three red bars on the right. The first red bar of minus $3.3 million is the fair value of the non-recourse government loans from the Israeli Innovation Authority, the IIA. This debt is primarily comprised of non-recourse loans that we received from the IIA under the old IIR financial program and current operational loans for the incubator. Those loans only come due when there is an exit. The second red bar shows deferred revenue of approximately $1.4 million. It makes up of a long and short-term liabilities, representing our commitment to provide our portfolio companies with a 2 years worth of support in exchange of some of the shares we have received. Since the value of the new portfolio companies in our books includes the value of those in-kind services, we record a liability which reflects our commitment to provide those services over the 2 years period. As the services are provided, we reduce the amount of the liability and report income from the services as we earned the equity that we received in the portfolio company. The deferred revenue, although classified as liability in our balance sheet, are not a cash liability, but rather represent our liability to provide the services. The largest part of our long-term liability is deferred taxes, which at the end of June were $14.5 million. Deferred taxes represent the theoretical tax liability that is occurred when there is an increase in the carrying value of our investment portfolio. Those taxes only become due when an exit occurred. To reiterate, none of those long-term liabilities has a due date or for payment. The deferred revenue represent our commitment to provide services to our portfolio companies, while the loans from the IAA and the deferred taxes are only payable upon an exit event. The net asset value per share is 17 Singaporean cent, which means that our shares are currently traded as at about 34% discount to this NAV. I would like now to turn the presentation over to Todd to share some of post-half-year developments.
Thanks, Chaim. Before we move to Q&A, I'm going to update you on our post-first half 2020 developments, those things that have occurred since we closed our financials for the first half. Our in-house innovation center, Trendlines Labs, has expanded into Singapore. Building on the success of Trendlines Labs in Israel, Trendlines Labs Singapore, our Singapore-based in-house innovation center, is focused on inventing medical technologies and developing solutions and products to meet critical unmet market needs. And it does so through close partnerships with healthcare institutions, universities, multinational corporations, and the startup ecosystem of Singapore. Operating as a business unit of Trendlines Medical Singapore, Labs Singapore will capitalize on Trendline's strong relationships with decision makers and clinical experts in the medical device industry to invent and develop innovative devices, supplies, equipment, and digital concepts. With the opening of Trendlines Medical Shanghai Innovation Center, or Trendlines Medical Shanghai, we are leveraging Trendline's innovation strengths and experience in the medical device industry and our unique incubation model of Israel and Singapore, combining Israel's technological and innovation capabilities together with Chinese medical companies' targeted R&D projects and partnerships with the Chinese government. Trendlines Medical Shanghai will incubate and commercialize new companies to answer China's and the global environment for healthcare needs. So with this, we have expanded our operations in Singapore in such a way that they substantially replicate what we do today in Israel. And in China, we have substantially expanded our activities during the course of this year and even post our first half report. And now I'm going to turn things over to Steve. But before that, let us note, looking ahead, that the pandemic has highlighted more than ever our health and our food as essential systems that we need to invest in to assure well-being and quality of life for all. We remain fully committed to our investment focus on the medical and agri-food centers, as we believe that these sectors significantly impact our lives, our quality of lives, and they truly have the potential to create great value for all of our stakeholders. And with that, Steve is going to review questions that we've received.
Thank you, Todd. I'll remind everyone now that if you have questions that you'd like to submit, you can do so through the question and answer function and the Zoom presentation at the bottom of the page. Simply click on the Q&A and then enter your question, and we'll be happy to receive it. Or you can send it by WhatsApp to Yehuda at the number that he read out at the beginning of the call, country code 972-55-685-5682. and we'll take a minute to see if we have any questions. And if not, then we'll thank everyone for their continued support, and we will get back to work. So seeing as that there have been no questions submitted, I guess that we will thank you all very much again for attending. You're encouraged to be in touch with us at any time. If you do think of questions afterwards that you'd like to ask, or if anyone listening to the recording of this earnings call has questions, please feel free to submit them at any time to Shira, S-H-I-R-A, Shira @trendlines.com, and we will be very happy to get back to you in a timely manner. Take care, everyone. Stay healthy, stay safe, and we look forward to a great second half of the year. Thank you.
Thank you.